Today, we will talk about the foreign exchange market. This chapter explores three main objectives. 1. Explaining the mechanics of the foreign exchange market. 2. Analyzing factors that influence exchange rates and the potential for prediction. And 3. Outlining how exchange rate changes impact international businesses. Understanding the foreign exchange market is essential for managers, as currency fluctuations affect sales, profits, and strategy. The foreign exchange market facilitates currency conversion for international transactions, which is crucial for global trade and investment. Due to unpredictable exchange rate changes, international businesses face foreign exchange risk fluctuations that can alter profitability. The chapter covers market functions, E.G., spot exchanges, forward exchanges, and currency swaps, and the factors influencing rates, with a focus on business implications. The foreign exchange market serves two main functions: currency conversion and providing insurance against foreign exchange risk. In currency conversion, each country has its own currency, and the exchange rate determines how one currency can be converted into another. This is essential for transactions involving different currencies. International businesses heavily rely on foreign exchange markets for various purposes. First, they convert foreign currency earnings into their home currency. Second, they use these markets to pay foreign suppliers in their local currency. Third, they invest spare cash in foreign money markets for short-term gains, considering interest rate differentials. Lastly, currency speculation involves short-term movements of funds to profit from exchange rate shifts, though it carries significant risks. A common speculative strategy is the carry trade, where investors borrow in a low-interest rate currency to invest in a higher interest rate currency, aiming to profit from the interest rate differential. However, this trade is risky, as adverse movements in exchange or interest rates can lead to losses. The dollar-yen carry trade was prominent in the mid-2000s, but declined later due to changing market conditions. A key function of the foreign exchange market is to provide insurance against foreign exchange risk, the potential adverse effects of unexpected exchange rate changes on a firm. When a company hedges, it protects itself against these risks. There are three types of exchange rates in the foreign exchange market. Spot exchange rates. When two parties agree to exchange currency immediately, they use the spot exchange rate, which is the current rate for that day's transaction. For instance, when a U.S. tourist exchanges dollars for pounds at a bank, they use the spot rate. This rate constantly fluctuates, determined by real-time demand and supply for each currency. If demand for U.S. dollars rises while demand for British pounds falls, the dollar may appreciate against the pound. By managing spot rates and other exchange rate mechanisms, companies use the foreign exchange market to minimize the financial impact of currency fluctuations. Fluctuations in spot exchange rates can pose risks for international businesses. For instance, a U.S. company importing laptops from Japan might face unanticipated costs if the dollar depreciates against the yen. If the exchange rate drops from $1 equal 120 yens to $1 equal 95 yens, the cost per laptop could rise from $1,667 to $2,105, turning a profitable deal into a loss. To protect against this, companies can use forward exchange contracts, which lock in an exchange rate for a future date. In this example, If the 30-day forward rate is $1 equal 110 yens, the company secures a rate that ensures a profit of $182 per laptop, regardless of currency fluctuations. Forward rates reflect market expectations, and a forward discount or premium indicates anticipated currency depreciation or appreciation. In sum, forward exchange contracts provide insurance against adverse currency shifts, helping firms maintain profitability in international transactions. For companies involved in international trade, the ability to engage in forward transactions is crucial. By 2010, forward transactions accounted for 63% of all foreign exchange transactions, with spot exchanges at 37%. However, most forward transactions were not traditional forward contracts, but rather currency swaps. A currency swap involves the simultaneous purchase and sale of the same amount of foreign currency for two different dates. Swaps help businesses, banks, and governments temporarily switch currencies without exchange risk. For instance, Apple, which buys laptop screens from Japan and sells laptops there, might use a swap to manage payments in yen. Apple could buy yen at the current spot rate to pay its supplier and enter a forward deal to convert future yen revenue from Japan back into dollars. This swap allows Apple to secure $1.09 million from future yen payments, providing insurance against currency fluctuations. The foreign exchange market is a global network of banks, brokers, and dealers connected electronically, with key trading centers in London, New York, Zurich, Tokyo, and Singapore. It operates continuously, with only a brief 3-hour pause in trading worldwide. London's central position between Asia and the U.S. gives it a dominant role in the market, covering trades from both regions and making it a vital connection in global currency trading. This market is highly integrated, allowing minimal differences in currency rates across centers. If discrepancies arise, arbitrage quickly erases them as traders buy currency in lower-rate markets and sell in higher-rate markets, profiting from the differences. The U.S. dollar is the primary vehicle currency in foreign exchange transactions, involved in 85% of trades in 2010 due to its liquidity and wide acceptance. Other key currencies include the euro, Japanese yen, and British pound. Meanwhile, the Chinese renminbi remains less prominent, used in only 0.3% of transactions, largely due to its value being pegged to the dollar and not fully determined by market forces. Exchange rates are fundamentally determined by the demand and supply of currencies. When the demand for a currency like the dollar exceeds its supply, it appreciates, while the yen, for example, would depreciate if its supply exceeds demand. However, this basic explanation doesn't account for the underlying economic factors driving currency demand and supply. Understanding these factors, such as a country's inflation rate, interest rate, and market psychology, can help predict currency movements, though predicting these is challenging given the complexity of influencing factors. One essential concept in understanding exchange rates is the law of one price, which states that identical goods in free markets should sell for the same price when expressed in a common currency, provided there are no transport costs or trade barriers. For instance, if a jacket costs $80 in New York and the exchange rate is £1 equal $2, the jacket should cost £40 in London. If the price differed significantly, traders would exploit this by buying the jacket where it's cheaper and selling it where it's more expensive, arbitrage, leading to price adjustments in both locations until prices equalize. This principle is a foundation of purchasing power parity, PPP, which links exchange rate changes between countries to their relative price levels. The purchasing power parity, PPP, theory suggests that exchange rates will adjust to equalize the prices of a basket of goods across different countries, assuming efficient markets and minimal trade barriers. The PPP exchange rate can be calculated by comparing the prices of identical goods in different currencies. The Big Mac Index, used by The Economist, exemplifies this concept by comparing the price of a Big Mac burger in various countries to assess currency valuations. If a currency's actual exchange rate diverges from the PPP predicted rate based on relative prices, it may be deemed overvalued or undervalued. Furthermore, according to PPP theory, exchange rates will change if relative prices change due to factors like inflation. For instance, if prices rise in one country compared to another, the exchange rate should adjust accordingly to reflect the new price levels, maintaining parity between currencies. PPP theory suggests that changes in relative prices, driven by inflation, will lead to changes in exchange rates. If a country experiences high inflation, its currency is expected to depreciate relative to countries with lower inflation. The growth rate of a country's money supply is a key factor in predicting future inflation, as an increase in money supply without a corresponding increase in output leads to inflation. Inflation occurs when more money is available, causing increased demand for goods and services, which drives up prices. This imbalance between money supply and output growth leads to currency depreciation. A clear historical example is Bolivia in the 1980s, where hyperinflation resulted in a massive depreciation of its peso. The correlation between money supply growth, inflation, and currency depreciation followed the predictions of PPP theory. Governments control the money supply, and excessive expansion can lead to inflation and depreciation of the currency. By examining a country's monetary policy, businesses can predict future inflation and currency movements. If a government increases the money supply without controlling inflation, the currency will likely depreciate. Countries that have struggled with this issue historically include many Latin American nations and some Eastern European countries. For example, the U.S. Federal Reserve's decision to expand the money supply through quantitative easing in 2010 sparked concerns about potential inflation and a weakening of the dollar. The purchasing power parity, PPP, theory suggests that exchange rates adjust based on relative prices, predicting that high inflation will cause a country's currency to depreciate compared to countries with lower inflation rates. While this holds to some extent in the long term, empirical studies show PPP theory is less reliable for predicting short-term exchange rate movements, particularly in industrialized nations with low inflation differentials. The theory also assumes no transportation costs or trade barriers, but these factors often lead to significant price disparities, weakening the PPP relationship. Government intervention in trade and foreign exchange markets further disrupts the link between inflation and exchange rates. Additionally, multinational corporations with significant market power can set different prices in various countries, price discrimination, limiting arbitrage opportunities. Lastly, investor psychology and speculative activities can impact currency values, adding unpredictability to exchange rate movements beyond what PPP can explain. The Fisher effect, developed by economist Irving Fisher, explains that nominal interest rates are the sum of a real interest rate and the expected inflation rate. In countries with high expected inflation, nominal interest rates will be high as investors seek compensation for inflation's impact on their returns. When capital can move freely across borders, real interest rates equalize across countries due to arbitrage, meaning differences in nominal rates reflect varying inflation expectations. The International Fisher effect, IFE, builds on this, proposing that the spot exchange rate between two countries should change in proportion to the difference in nominal interest rates, moving in the opposite direction. For instance, if U.S. nominal rates are higher than Japan's, suggesting higher expected U.S. inflation, the dollar should depreciate against the yen by the interest rate differential. However, while IFE predicts long-term correlations between interest rate differentials and exchange rate movements, it, like PPP, is unreliable for forecasting short-term exchange rate changes. Empirical evidence shows that neither PPP theory nor the International Fisher effect effectively explains short-term exchange rate movements. One significant factor influencing these short-run changes is investor psychology, where expectations of market traders can drive self-fulfilling prophecies. A well-known example occurred in 1992, when financier George Soros shorted the British pound, sparking a massive sell-off as other traders followed his lead. This bandwagon effect caused a sharp depreciation of the pound without major changes in economic fundamentals. Investor psychology, often swayed by political and microeconomic events, plays a crucial but unpredictable role in exchange rates. Bandwagon effects, often amplified by political actions, were also evident during the 1997 Asian financial crisis, when multiple Southeast Asian currencies depreciated sharply. Relative monetary growth, inflation rates, and nominal interest rate differentials provide moderately accurate predictions for long-term exchange rate changes, but are unreliable for short-term predictions due to factors like investor psychology and bandwagon effects. For international businesses, monitoring these economic indicators is valuable for understanding long-term impacts on foreign investment profitability, export opportunities, and import competitiveness. However, predicting short-term exchange rate movements remains challenging, limiting the ability to anticipate daily fluctuations in foreign exchange transactions. Okay. Now we have exchange rate forecasting. In exchange rate forecasting, two main perspectives debate the value of investing in forecasting services. Efficient market school. This view holds that forward exchange rates reflect all publicly available information and therefore represent the best possible forecasts of future spot exchange rates. Since an efficient market includes all relevant data, companies gain no advantage by investing in additional forecasting. According to this school, forward rates are unbiased predictors, meaning their errors are random rather than systematically high or low, though specific predictions may still be inaccurate. Most empirical studies support this hypothesis, indicating that additional forecasting may be unnecessary, though some recent research challenges this view. The inefficient market school challenges the efficient market hypothesis, arguing that forward exchange rates may not fully reflect all available information, making them unreliable predictors of future spot rates. In an inefficient market, investing in forecasting services could be beneficial, as professional forecasts might offer better accuracy. However, The success of these services has been mixed. They failed to foresee major events like the 1997 Southeast Asian currency crisis and the unexpected rise of the U.S. dollar in late 2008 during the financial crisis. These examples highlight the limitations of professional forecasts, especially in predicting sudden, large-scale economic shifts. The Inefficient Market School proposes two approaches for improving exchange rate forecasts: fundamental analysis and technical analysis. Fundamental analysis. This approach uses economic theory and econometric models to forecast exchange rates based on variables like money supply growth, inflation, interest rates, and balance of payments positions. A country with a current account deficit, for example, might face currency depreciation due to increased foreign demand for other currencies if foreigners are unwilling to hold that country's currency. However, this effect can be offset if the country has favorable interest rates, low inflation, or a strong investment market which attract foreign capital. This was evident from 1998 to 2001, when the U.S. dollar appreciated despite a current account deficit because high real interest rates, low inflation, and a booming stock market made U.S. assets attractive to foreign investors. Ultimately, fundamental analysis suggests that the main determinants of exchange rates are monetary growth, inflation, and interest rates. Technical analysis. This method forecasts exchange rate movements by analyzing past price and volume trends, assuming these trends will continue in the future. Unlike fundamental analysis, it does not consider economic fundamentals, instead relying on the idea that market trends and patterns are predictable based on historical data. Although technical analysis lacks a theoretical foundation, which leads many economists to view it skeptically, comparing it to fortune-telling, it has nonetheless gained popularity in recent years. Currency convertibility varies based on government restrictions. A currency is freely convertible if both residents and non-residents can exchange it for foreign currencies without limitations. It is externally convertible when only non-residents have this freedom, and non-convertible when no conversion is allowed for either group. Most countries impose some restrictions, allowing external but not full convertibility. This limits residents' access to foreign currency, but often doesn't impact foreign businesses, which can usually convert profits and take them out of the country. However, in non-convertible currency systems, as seen in the former Soviet Union and early post-Soviet Russia, foreign businesses face serious challenges as they cannot exchange local profits for foreign currency and repatriate them, complicating international operations. Governments limit currency convertibility to protect their foreign exchange reserves, which are essential for servicing international debt and purchasing imports. Restrictions are often imposed to prevent capital flight, which occurs when residents and non-residents rush to exchange domestic currency for foreign currency, especially during periods of economic instability or hyperinflation. This can drain reserves, cause a depreciation of the domestic currency, and lead to higher import prices and inflation, which governments want to avoid. To navigate non-convertibility, companies may engage in counter-trade, where goods and services are exchanged instead of using currency. Examples include General Electric accepting Romanian goods in lieu of cash, or Caterpillar trading heavy equipment for iron ore and other goods. While counter-trade was more common when many currencies were non-convertible, its prevalence has decreased as more currencies have become freely convertible. likely accounting for less than 10% of world trade today. Okay, the last part we talk about is managerial implications. This chapter emphasizes the critical need for international businesses to understand foreign exchange risk, which can significantly impact the profitability of trade and investment deals due to fluctuations in exchange rates. Foreign exchange risk is categorized into three types. Transaction exposure, which involves the risk of income loss from specific agreements affected by currency changes. Translation exposure, which concerns the impact of exchange rate shifts on the financial statements of a company, potentially altering reported equity and borrowing costs. And economic exposure, which relates to the long-term effects of currency fluctuations on a firm's future earning power and competitiveness. By recognizing and managing these risks, businesses can better navigate the complexities of global markets. To minimize transaction and translation exposure, firms can employ several tactics aimed at protecting short-term cash flows from adverse exchange rate fluctuations. Key strategies include entering into forward exchange rate contracts and utilizing currency swaps, which have been discussed previously. Additionally, firms can implement leading and lagging strategies for payables and receivables. A lead strategy involves collecting receivables early or paying payables before they are due when expecting unfavorable currency movements, while a lag strategy entails delaying collections or payments when a currency is anticipated to appreciate. However, these strategies can be challenging to implement, as they require firms to have control over payment terms, which may not always be feasible, especially with powerful customers. Moreover, some governments impose restrictions on payment timing, such as setting limits on the duration for which payments can be delayed or advanced. To effectively reduce economic exposure, firms must make strategic decisions that extend beyond financial management. A primary approach involves distributing productive assets across various locations, which helps mitigate the long-term impact of adverse exchange rate changes on the firm's financial health. For instance, some European companies have established local production facilities in the U.S. to counteract the competitive disadvantage posed by a strengthening euro. Similarly, Toyota has strategically placed production plants globally to prevent a rising yen from pricing its cars out of local markets. Caterpillar has also adopted this strategy, setting up factories worldwide to guard against the potential pricing challenges posed by a strong dollar. This real hedge proved beneficial during the economic downturn in 2008 and 2009. The chapter also highlights how two German firms have sought to reduce their economic exposure through similar strategies.
Thank you for watching. If you liked this video, please like and subscribe to channel.